Canada is quietly becoming one of the biggest economic winners in North America, while warning signs continue to spread across the US. Investors are paying close attention, and the gap is growing larger. The reasons behind this growing divide are starting to raise serious attention. There is one number in the global economy that tells you more about where things are heading than anything else you will read in a news headline, a tweet, or a political speech. It is not GDP. It is not unemployment. It is not the stock market index that flashes across television screens every afternoon. It is the US 30-year bond yield, the rate at which investors demand to be paid in exchange for lending money to the American government for 3 decades. And right now, that number is telling a story that most people are not paying close enough attention to. In 2020, the US 30-year bond yield sat at approximately 1.3%. That was the historic low point of a trend that had been running for 40 years. From 1980, when the yield sat at around 12%, the number had been declining with ups and downs along the way for 4 full decades. That 40-year decline in borrowing costs is not a footnote in economic history. It is the foundation of nearly everything that drove prosperity across the developed world during that period. Cheaper borrowing costs meant cheaper mortgages, cheaper corporate debt, more affordable government spending. The entire architecture of modern economic growth was built on top of interest rates that kept declining year after year for a generation. That trend has now reversed. The US 30-year bond yield has climbed from that 2020 low of 1.3% to over 5% today. And for anyone who understands what that number means, the implications are serious, not for this quarter or next year, but for the next decade, the next generation. And the economic reality that young people entering adulthood today will spend their working lives navigating. The bond yield is not an abstract financial instrument. It represents the most honest answer available to a very simple question. How much do investors need to be paid before they are willing to lend money to the United States government for 30 years? When that number goes up, it means investors are less confident. They need more compensation for the risk of holding American debt over a long horizon. They are less certain that the dollars they get back in 30 years will carry the purchasing power of the dollars they lend today. Inflation erodes that purchasing power. When inflation is high and investors expect it to stay high, the yield goes up to compensate. The current American inflation situation is specific and documented. Wholesale inflation, the price of goods before they reach consumers, jumped 6% in April on an annual basis, the biggest increase since 2022. Consumer inflation followed at 3.8% in April, well above the Federal Reserve's 2% target. The Federal Reserve has now failed to return inflation to its 2% target for more than 50 consecutive months. That is a sustained, documented failure that is directly reflected in the bond yield rising above 5%, as investors price in the expectation that inflation will remain elevated. Here is the specific policy mechanism that is making this worse rather than better. Every major action the current American administration has taken on trade and economic policy pushes in the same inflationary direction. Broad import tariffs raise the price of goods sold to American consumers. That is not an opinion. It is the documented mechanism by which tariffs affect consumer prices. The conflict in Iran has pushed energy prices higher, feeding through into transportation and manufacturing costs across the entire economy. These are simultaneous upward pressures on inflation, arriving at a moment when the central bank responsible for fighting inflation is under sustained political attack. The Federal Reserve Chairman has been publicly criticized, mocked on social media, and threatened with removal by the president specifically because the Fed has maintained interest rates to fight inflation rather than cutting them to stimulate economic activity. Lloyd Blankfein, former chairman and CEO of Goldman Sachs, described the consequence of that dynamic with precision. He explained that the United States defaults not through a formal debt announcement, but by inflating its currency, paying back loans in dollars that carry less purchasing power than the dollars originally borrowed. And he stated that the creditors lending money to the United States are relying on the Federal Reserve's independence to preserve the integrity of those dollars. Undermine the Fed's independence, and creditors respond by demanding higher yields. That is the mechanism that is currently operating in real time in American bond markets. Now the administration has appointed a new Federal Reserve chairman who is described by financial analysts as less concerned about inflation persistence than current Fed officials. The president has installed someone more likely to lower interest rates despite elevated inflation, the precise combination that Blankfein's warning described. Creditors watching that appointment are rationally adjusting their expectations about future inflation and demanding the higher yields to compensate. Canada's position in this environment is the striking contrast that most financial commentary has not adequately addressed. In 2022, Canadian and American 30-year bond yields were approximately equal, both around 1.8%. They moved together briefly as inflation rose globally following the pandemic and the Ukraine war. Then they diverged. Canada's 30-year yield climbed to approximately 3% by 2023 and has remained relatively flat since, sitting today at around 3.8%. The United States yield has continued climbing to over 5%. The gap between where Canada borrows and where the United States borrows is now over 1% on long-term debt, and it is widening. That gap is not a coincidence. It reflects a documented difference in how the two countries are managing the fundamental question of monetary credibility. Canada has a prime minister who is a former governor of the Bank of Canada and the Bank of England. He does not need the mechanisms of monetary policy explained to him. He understands why central bank independence is not a bureaucratic preference, but a structural necessity for maintaining creditor confidence. He has not threatened to fire the governor of the Bank of Canada. He has not demanded interest rate cuts on social media. The Bank of Canada has been allowed to do its job. That difference in institutional credibility is precisely what the bond markets are pricing. Investors holding Canadian 30-year bonds do not demand the same yield premium as investors holding American bonds because they are not pricing the same institutional risk. The Bank of Canada's independence is not currently under threat from the government. The governor is not being publicly mocked by the Prime Minister. The creditors lending money to Canada are more confident that the dollars they get back will carry something close to the purchasing power of the dollars they lent. That confidence is worth over 1 full percentage point in borrowing cost. When bonds mature and governments must issue new debt to repay them, the interest rate on that new debt is the rate prevailing at the time of issuance, not the rate from when the original bond was issued. A country rolling over large amounts of debt at 5 and 6 and 7% rather than 2 and 3% faces a compounding structural problem that converts into a real fiscal crisis, not as a theoretical scenario, but as an arithmetic certainty. The United States is currently on that trajectory. Canada is not. The 40-year era of declining interest rates that funded a generation of economic growth is over. The direction has reversed. That reversal will affect every person who borrows money, every government that runs a deficit, and every generation that inherits the fiscal consequences of decisions made now. In that environment, the country with the lower yield, the independent central bank, and the economically literate leadership is not simply doing better than the alternative. It is building the institutional foundation that decades of financial stability require. The bond market is not a political statement. It is the most honest signal available. Right now, that signal says Canada is heading in a different direction than the United States.